The broadcast is now starting. All attendees are in listen-only mode.
Hello, and welcome to today's webinar. I'm Nick Zulovich, Senior Editor of Subprime Auto Finance News. Thank you so much for joining us. In today's webinar, where we ask where to cut losses and drive revenue, we're going to learn more from Jeremiah Wheeler, who's the Vice President of Financial Services at DRN, Digital Recognition Network. But before we get started, I wanted to go over a few housekeeping items for today's webinar. Please make sure you've dialed in using the phone number provided in your communication email, or you're able to listen via your PC speakers. We are recording today's webinar, and we'll make that recording and Jeremiah's presentation available to you as soon as possible. You'll be in listen-only mode for this webinar, but we will reserve some time after the presentation for a Q&A session. You can submit your questions at any time through the questions box on the GoToWebinar control panel. And if we aren't able to get to your question today, don't worry, because we'll forward it on to the team at DRN so they can respond back to you directly via email. And lastly, if you have any difficulty during today's webinar, please click on the hand icon on the control panel to alert a member of our team. With more than 10 years of experience in collections, recoveries, and more, let's bring on DRN's Jeremiah Wheeler. Jeremiah, the webinar floor is now yours.
Hello, everyone. First of all, let me say thank you for taking time out of your day to join us and learning a little bit more about how lenders are using WHERE data to save millions and drive revenue. We'll get started here. So first we'll start with the headline. The headlines everyone's been seeing over the past year or so with auto debt topping $1 trillion. By now, the 1 trillion number is really old news because everyone's been seeing it over and over. But every day, we're getting news that with the boom in auto delinquencies and with the subprime market taking the brunt of those delinquencies, lenders are telling us that they are seeing those delinquency rates represent an ongoing challenge for the industry with millions of dollars at risk. So today, the delinquencies and challenges basically are disrupting your organizations, causing you to take different approaches and try to find the best way to mitigate those losses. So the challenge really is to disrupt your organization before someone else forces you to. And so we don't want to remain complacent and pass the opportunity to take advantage of the new loan volumes and using WHERE data to do so. So we've seen a historic shift towards subprime since 2008. The base for subprime auto loans has really grown over the last 8 years. In 2007 and 2008, where there were really 8 to 12 lenders using subprime securitizations. And today, that number's really around 25 or more. So the competition is there, and it's really heating up. And there are more and more subprime borrowers in the space since 2008, with the mortgage crisis really causing that subprime group to grow more and more. As well as there are a lot of millennials coming into the space now at a very high number, and they're moving out of their parents' households and buying cars, therefore causing a dynamic shift in the marketplace to where that subprime base is really getting bigger and bigger. And so it really is bringing the challenges of the higher risk profiles with the promise of higher rewards to the forefront. And so we get that you have to compete around the base of customers that need the loans, but how do you use better data, better strategies to help mitigate those risks earlier in cycle so that they don't really reach up and bite you. So, what happens when the subprime paradigm shifts to that high risk, low reward, and we've seen the buying like never before, but also creeping up, that failure to pay is really taking its toll. Americans bought new cars at a rate higher than ever before last year, even as the boom in auto sales has been increasing. But the call is really to innovate, to deliver better returns, lower risk, and synergy to the top line. And competitive results, followed by the high risk and high reward model, is really starting to look like the high risk, low reward model for some lenders out there. And then we also take into account some of the later headlines, or the earlier headlines that we've seen here recently, where Fitch Ratings is basically reporting that the risks are increasing, the delinquencies are increasing at a rate higher than what the bankers are really, or the lenders are comfortable with. And some lenders are they've even started cutting back on originations in that space. And I'd venture to say that some people on this call are thinking about those same strategies and may even be enacting some of those strategies already. So basically increasing the increase in the cost of risk there's a couple of factors there. Competition, which we talked about earlier, how many more subprime lenders there are in the space. It's driving lenders to buy deeper and write longer term loans to make the loans more attractive to those subprime borrowers and to where they can really truly afford it, so to speak. The riskier loans obviously equal to more charge-offs, more delinquencies, and it's forcing lenders to take a different really cost of the organizational structure into play, where it's forcing you to staff up, and it's also increasing in the severity of losses, resulting in deficiency balance growth as lenders net less at auction due to the more inventory coming off of lease returns and other factors playing into like the rental car industry, and the auction numbers are just soaring through the roof, therefore driving the volumes or the value, so to speak, down. So that group, though, of good paying customers tends to be shrinking a little bit more and more, and that's what we're hearing from a lot of lenders, is that they need new, better ways to help identify those riskier loans earlier in the cycle. So we've heard from a few lenders, it's broken, and so what we're saying is, let us help you fix it. So waiting for the magical 45 days past due to start our internal skip processes basically means we may be waiting too long. And we hear a lot of lenders saying, hey, we're repoing the wrong cars. Our redemption rates are at an all-time high, which means we could have possibly gotten that money before we got the car. So therefore, there's got to be some strategies out there that we can enact that will help us identify those and maybe take some different steps to avoid the repossession in some cases, or get the repossession earlier because we see those higher risk factors. And the bigger thing is we're forced to cut what's making us money. Lenders that are making good money in the subprime space with the longer term loans, higher interest rates, they're forced to cut those strategies or increase their head count, increase the number of collectors just to keep up with that volume, therefore cutting their margins. And they're adding so many staff members to help address the delinquency volumes, but are not really seeing that improvement in the loan outcomes. There's also a Business Insider article basically that stated since the wage growth has been unequal to the wages of non-wealthy Americans, it's basically creating that pool of borrowers that maybe can't afford to pay for all of their loans and their promises to pay across the board. And so in other words, borrowing has basically become a way more expensive mean for these people. And as borrowing costs increase, it becomes more difficult for some Americans to cover expenses like car loans. And they usually pick, which loans they're going to pay, and sometimes the car loans are the ones that suffer and force, and basically face the brunt of the non-payment. And so with that being said, the culture's really changed. People in particular, younger Americans, they don't think delinquency is all that big of a deal. And some surveys recently released, some of the millennials, some of the younger borrowers out there have basically graded themselves as a quote-unquote C level in financial literacy. So they may not completely understand what they're getting themselves into when they sign up for that car loan. They also may not know what they're getting themselves into or balance it against the rest of their outgoing expenses to the tune that they're able to pay you guys in an efficient manner. And so therefore, again, lenders are saying, hey, we're going to have to force or cut what's making us money. And here at DRN, we don't want to see that. We want to see lenders making money. We want to see people driving cars. We want to see more people getting cars because everyone needs cars. That's just a fact, and that's not going to change anytime soon. So the question is really, do you know where your vehicles are right now or where they were 30 days ago? That's a really good question. The answer to these questions have a huge impact on your portfolio. The answers to where matters. The answers to where could mean the difference between having capital to leverage for originations instead of placing them in a loss reserve, which lenders typically do, which is a good business practice, obviously. You got to manage your budgets and manage your loss reserves and loss ratios and stay in line with what your investors want to see. But knowing where earlier could really change that landscape for you and also change how much you're having to place in loss reserves if you're able to mitigate those losses earlier in cycle due to where data. So did you realize that 90% of the time you're within 1,000 feet of your car? So if you can locate the asset, typically you can locate the debtor. So if you knew how frequently an asset was at a particular location or what time of the day or day of the week it was there, what would you do? Would you call your debtor at that location to attempt to cure the loan, or would you assign it out earlier to prevent that charge-off from occurring? So once you know where to locate your debtor, you know what to do. That's what you do best. We've even seen some lenders delaying repo assignment by an additional 10 days because they know where the car is. They know that they have solid location information from DRN to change their strategy slightly on those quote-unquote higher risk loans. But when you know where the car is and you know when it's there all the time, then you can make different strategy changes that will help you cure more loans or get the cars faster and cut that repossession time in half. So here at DRN, we know where vehicles are, and a lot of them. We have over 5 billion sightings in our network right now, in our database, and it's growing at a very rapid rate. It's growing at almost 150 million new sightings per month. Last month, we had about 152 million plate sightings across the country in over 380 markets. So we're providing that where data to lenders so that they can make better informed decisions and know when and where to go to get the asset faster, cutting those days to repo nearly in half, which means you can get the car, you can take your first initial write-down, and you can liquidate that car before you're forced to charge it off and take a full balance loss. Let me give you an example. So a lender thought this car was in Missouri. And this is for a top 20 auto lender. The fact of the matter is, the car was not in Missouri. We generated new locations more than 700 plus miles away in Dallas. And look at there, it's a possible work address. So here, same vehicle again, not in Missouri, where the lender was trying to recover it or make contact, and we could tell them when and where it was, what day of the week and time of the day it was there, as well as the address. And you can see that this is likely a residential address. So we have a work address for them and a home address because the person had obviously moved, and that lender was still working on older data that was provided to them in some cases by the customer, or what we call self-reported data. When you fill out an application for a new furniture or you fill out a new utility, that's self-reported information. The where data that we provide is not self-reported. It's gathered through that network of cameras running around, scanning those license plates, and we're able to provide those insights at any time during delinquency, or even before, if that's the case, if you wanted to monitor for behavioral scoring. So here's another example where we had a given address on a unit in Bluefield, Virginia. The charge-off date of this unit was 2/25 of 16, no repo. Full balance charge-off was taken on this unit. We cited this unit on January 4th until the time it charged off 9 times. So we would have given a score on this of 6,300, which means we've seen it 6 times in the last 30 days and 3 times in the last 31 to 90 days. So we could have given insight to this lender to tell them, you're looking in the wrong place, go over here to get the car, and you could have prevented that charge-off and saved 21 days on the time to repo prior to charge-off. So in some cases, we've seen assignments being ran for weeks at a given address, only to find out that the vehicle was located a mere 3.5 miles away at an apartment complex, because we all know that the subprime borrower tends to be more transient, and they tend to, the delay in self-reported information is typically 30 to 60 days before we can get our hands on it in the skip tracing world. So if we've waited 30 to 60 days, we probably waited too long. We could have had better, insightful information earlier. So we want to bank on location data to help mitigate risk, drive revenue, and identify those higher risk, low reward accounts earlier in cycle to flip that script and turn it into a high risk, high reward situation. So some of this data you may already be using at repo. Some lenders are using it at earlier than repo. Some are using it at repo. We currently have about 220 plus lenders on our new enterprise DRN sites model. And we've seen some lenders recovering up to 35% more vehicles than their traditional means and methods. We've seen others reducing charge-off losses by providing new locations or making contact on 30% of their delinquent accounts, and we've reduced their days to repo by up to half, which is big, especially when you're talking asset values being where they are at auction. Shrinking that time to repo is very important, not only for just helping with asset value, but also helping you to liquidate that asset before you're forced to take a charge-off. I want to give you a couple of examples of some subprime lender results. So we have this particular lender we helped on average, we assisted in 90 DRN assisted repos per month. And these were proven through reporting capabilities that we have, where we could tell that lender, hey, we helped you find this car. Not only did we help you find it, but we found it away from all the given addresses that you had on that account and near the hit location that we provided to you. So therefore, going down, checking the boxes and saying, is this a DRN recovery? Can we prove it's a DRN recovery? And in most cases, we can. So the reduction in their repo expense was $22,500. The other thing we've done for all of our lenders on that program is we provide in-depth on-site training with all their collectors to be sure they understand how to use our tools, what the reports mean, what they show, which report to go to first, and which reports to go to second for monitoring, so that you will be alerted for any new sightings. So the monthly reports, repossessions resulting basically from DRN scans. So if we have scans that are within a quarter of a mile from a repo address, and the repo address is greater than a mile away from the given address, then you can usually chalk that up to a DRN where data recovery. Another good example, we reviewed this lender's charge-offs, and this was what we consider a post-charge-off study. Sorry, my slide flipped. So we did this study. We looked at 4,624 VINs, unique VINs. We were able to plate 4,093 of those, and we had sightings on 60% of those. And we found alternate locations where the vehicle had been sighted multiple times within a very tight radius of an address on 15% of those. Since doing this study, that 15% is now climbed upwards of 30 to 35%. And so what this means for this lender is that during the time that the counts before they went to charge off and before they went out for repo, we could have helped them and assisted them with approximately 458 recoveries, preventing all of those from charging off with an average loan balance of 15 grand, saving them over $9 million in prevented charge-offs. That's a big number. We have an additional top 20 lender where they were using vehicle location data directly into their collections platform. They took it a step further and they said, you know what, we don't really want to use your tool that you created. We would rather just hook into your APIs for all those products and tools that you have created and bring them directly into our collections platform. Why? Because they can alert their collectors at 45 days past due or even 35 days past due and get alerts when the vehicle's been seen greater than 100 miles away from the locations that they are about to assign that vehicle out for repo, and say, this is a high-risk account because this vehicle is not where you think it is. So send it to a senior collector, allow them to use additional skip tracing tools along with our where data, and get alternate addresses to make contact, keep people in their loans, recover more vehicles faster, and reduce those charge-offs. And with that same lender, what that has done for them is they've averaged about 68 to 70 units per month that they've been saving from charging off, and it's totally changed their loss curves. And now their loss reduction, excuse me, their loss reduction on the per month savings is exceeding over $300,000 a month. So they can take that money now, if they continue this trend, and they can pull it from having to place it in their loss reserves, and they can do more things with their dealers. They can do more things for the originations. They can do more things in marketing to grab those customers that they're looking for. So I guess the real question is what is your risk mitigation strategy? Are you asking the right questions? Enhance your strategies around where data and get ahead of the risk. So vehicle location intelligence in the risk management area, collections area, and recovery areas are helping they're using it in 45, 60, and 90 days past due to help identify better addresses for collections and recovery. They can skip with new phone numbers and addresses. Based on our data and our clustering algorithms, we can tell you where the car has been seen multiple times and not only provide you with that address along with the scores, but also provide you with phone numbers for those addresses. It's pretty easy information to gather, but once you have that non-self-reported information along with the locations, then you may have a better place to contact, a better place to draw the lines across to your comp report that you're looking at and say, you know what, this person's parking at grandma's house now and have been over the past 3 months, and we're still looking at their current address that we had on the loan origination or on a older comp report. So, excuse me, the panic is not a risk strategy. It's not at all a risk strategy. The opportunity in 2017 with the delinquencies we see that we will see continue to climb throughout the rest of the year is to take advantage of that volume and use insights, scoring, and wear data to help provide different strategies for helping you to collect earlier. So vehicle location data, it does hold the keys. It may not hold all the keys. It may not be the one-stop shop for your overall collection strategy, but it can help provide better insights, especially into those higher risk loans and those higher risk accounts that are going to traditionally go through the entire cycle and make it to repo assignment and eventually make it to charge-off. So don't be forced to stop doing what makes you money. Employ strategies that can make a difference now versus knee-jerk reactions that you may be forced to do to try to make a difference. And see how far you can go by starting with where. So that concludes my slide presentation. So we can take some questions now from the audience. If you have any questions, feel free to use the GoToMeeting panel there to ask your questions, and I'll turn it back over to Nick.
Excellent presentation, Jeremiah. A lot of great information and connecting some of the latest trends that we've all been seeing with the capabilities of this data. And as Jeremiah mentioned, please use the questions box on the GoToWebinar control panel to ask your inquiry. And just a reminder that we are recording today's session, so keep watch of your inbox for a message containing a link to the recording of today's session, as well as a path to download Jeremiah's presentation so you could go through this material again or share it with other individuals in your department or elsewhere and be able to collaborate from there. So perhaps a way to get us started here, Jeremiah, with our Q&A session is certainly operationally using this type of data is a change in process for lenders and finance companies. What are some perhaps some initial steps that lenders can take to operationalize this data and to leverage it with whatever systems and processes they might already have in place?
Well, Nick, that's a good question. And, you know, we have seen a lot of different ways that lenders have chose to operationalize this. The good news is that, you know, we don't have to haul some equipment or servers or anything into your office. We don't have to install, you know, a program on all of your collectors' machines. Our tools are all web-based. You simply log in, you put your portfolio in there, you put your delinquencies in there, and then it's there to manage, it's there to interact with all the location reports, it's there to interact with the alerts. What we've seen a lot of lenders doing, though, outside of just our platform, is they've chosen to integrate directly into our services and pull that data into their collections platform so that their collectors are not having to go out to our web-based portal to interact with the data. They literally get the alerts right then and there in their collections platform. They can take action on it. They can, use their strategies internally. But then we also have some other lenders that say, you know what, the collections platform is one way to do it, but we do like using the tool because it is very quick, it's responsive, it's very intuitive, simple to use, and they literally just, as soon as it gets to a certain days past due, they choose to run it through the system to see what the scores are. For one, scoring your addresses that you have on the account is really important. If you understand that your addresses that you have on that account are all bad or they're not confirmed with LPR data, then we can help take the next step and provide the additional locations, additional sightings where we've seen that vehicle or where we've seen the vehicle multiple times, and then you can take affirmative action from there to either collect a little bit harder, delay recovery assignment a few days to try to collect harder, or assign it out earlier so that you're sure you get that collateral back and that you get it back in a timely manner. But we've seen a lot of different strategies. I would say that, for the most part, the lenders using it, the ones that are integrated directly into the collections platform, they've seen some really good results from doing that.
The voice you're hearing, that's Jeremiah Wheeler, who is the Vice President of Financial Services at DRN, Digital Recognition Network, and we're in the Q&A portion of our webinar today, titled Ask Where to Cut Losses and Drive Revenue, leveraging location data stemming from license plate scans to get a better intelligence on where your collateral might be. And we've used the monikers of lenders and finance companies throughout our discussion thus far, Jeremiah, but it sounds like there are some dealers who are joining our session today as well, and certainly in the buy here, pay here space, if the dealership has its own related finance company or they're originating their own contracts, they are certainly and would be in need of this data. If you could touch on just how not only the product helps lenders and finance companies, it could be a tool to help dealerships as well.
Absolutely. We do have a number of dealers that, buy here, pay here dealers that are responsible for not only the origination, but also, collecting on those vehicles or dollars associated to those vehicles. We probably have upwards of 70 plus buy here, pay here dealers currently on the system. There are a number of dealers and title lenders even that like to use the product, because when someone comes in and they sit down, they fill out that application, they say they live at 123 Main Street, and you can look out your window and see the car that they're driving. You can key that plate in and say, let's see if this person really does live at 123 Main Street. Come to find out they live over 200 miles away. The car that they're currently driving is always spotted 200 plus miles away, so there's a red flag. This may be fraud. It may be a straw purchase where they never intend to drive the vehicle. They're going to give it to someone else, and there it goes off into the sunset, and you may or may not ever find it again. We see a lot of fraud in the industry. I know that the insurance industry is suffering from a lot of fraud related to commercial use, related to other things that may void your insurance or may void that claim that you may be filing. So there's really a lot of ways to use it, and we do see a lot of dealers really getting on board and using it more and more in their collection efforts, as well as even in their originations processes.
Very good, very good. The voice again you're hearing is Jeremiah Wheeler. He's our guest expert today, the Vice President of Financial Services at DRN. I'm Nick Zulovich, the Senior Editor at Subprime Auto Finance News, and we're very glad you're joining us today to learn more about how location data can be beneficial to your finance operation in a myriad of ways. And we've discussed the capabilities of the data, but perhaps another appropriate question to ask here, Jeremiah, is just what is the time to impact for lenders and finance companies versus other risk mitigation strategies they might have? I guess perhaps how long might it take to see some results leveraging this kind of data as different from other processes or information they might have in-house already?
Well, it's funny you asked that, because we were actually in a demo. So the customer was not on board yet, and during the demo, sometimes we get put on the spot, and they say, well, where's my car? Where have you seen my car? Or let me go get you a list of cars. Let's see if we can find them right now. And so we sit down, take 15 to 20 minutes, punch in a few of those, and we've helped collectors literally find cars immediately that they've been looking for months, just by simply sitting down in a live demo, putting in the plates, and finding their cars for them. So results really are all up to you. It's all about how soon you operationalize the data, how soon you can get us in there to do the training and the walkthroughs with your collectors. And I've seen results start in as early as 10 days, where they really start to see not only just results, but results that represent an ROI to that organization for what they're paying for the product that far exceeds the cost. So I would say immediate. I mean, the response times of the system are really quick. So as soon as you can, as fast as you can type in that information, it'll be returned just as quickly.
That's very exciting, to say the least, that the quick turnaround that can be had. This is Jeremiah Wheeler, the VP of Financial Services at DRN. And if you could touch on just how DRN structures its processes as far as do lenders pay for each VIN or plate entered that you just described in the recent demo that you had, or is there an enterprise model for how perhaps there could be leveraging this data throughout the duration of the contract? Perhaps maybe some nuts and bolts to help people make a decision.
Yeah, so there are, we've been through a number of different pricing models over the years, and the price per VIN, yeah, it worked, it provided results, but at the end of the day, you're stuck with having people pick and choose which vehicles they want to spend the money on, so to speak. And so it always puts you in a position where, it puts us in a position where we're really not providing all of the value that we could provide to that lender. And so we come up with an enterprise model that is tailored to each lender based on the results that we can provide, that we think we can provide. We price it accordingly, and we work through with that lender on a weekly basis and definitely a monthly basis to be sure that we are providing the value that we're charging for, to be sure that they understand that value and that they're comfortable with the price that they're paying. So it's not just a one flat rate price out there for everyone, and it's just acceptable to everyone, because you have big lenders and you have small lenders. So we try to really take a consultative approach. We try to dig in with that lender and understand their portfolio, understand their charge-off losses, understand their days to repo, what are they wanting to change, how do they want to see that change, and what are the factors that are going to come into play when it comes to proving up the chain in their organization that what they're paying for, they're getting a 200 or 300% ROI on that cost. And so each lender, we do take that individual approach. We talk with them, we talk through the process, we get all their numbers, and we plug them all in, and we say, okay, let's, if we have to, we'll do a retro charge-off study to where we say, we inherently could have helped you find X number of vehicles per month over the last 2 years. So therefore, if trends continue as they have been over the past few years for your organization, then we should be able to help you do X, Y, and Z with your charge-off losses, with your skip fees, with your repossession assignments, with there are a number of different saving factors that come into play when we're pricing our products. And but I would say the majority of those come around really the ability to prevent charge-offs, the ability to prevent or cure loans faster, prevent recoveries and cure loans faster, or bring that days to repo down dramatically from what they have been seeing. And so I would say, we do have an enterprise model. It is a flat rate, all-you-can-eat buffet, so to speak, but it is individual based on volume, based on, losses that you're currently experiencing. And we try to make sure that, both parties agree on that before moving forward from a trial into a real live environment.
Very good, very good. And in our closing moments here, if you have a question for Jeremiah Wheeler, our special guest, who is the VP of Financial Services at DRN, please use the questions box on the go-to control panel. And before we address a couple of last inquiries, Jeremiah, you did a superb job of kind of laying the foundational trends of what's been happening nowadays, and one of the points you raised I thought was really interesting, stemming from how lenders and finance companies are seeking to repo the right car, that because redemption rates are in places not seen recently. If you could you revisit that point and just kind of set the table of what kind of atmosphere and market we're working in nowadays?
Well, I mean, what we've seen is all the way from the near prime lenders even to the super prime lenders as well as subprime lenders. We've seen a change in redemption rates to the point that lenders internally think that they're repossessing some of the wrong cars. And the reason I say that is because when the car is repossessed, within days of it being repossessed, the customer comes forward and makes the payment to redeem that car. And in doing so, it meant that they had the money. They had the money to catch the note up to make the payment prior to repo. And now that they have the repossession, they have the redemption, their fees to get back in that car are a lot higher. So not every car we're going to be able to save from being repossessed, and that's not inherently the point of our product, but it does obviously make a big difference when you can shave some of that off. I mean, when you talk about every single recovery out there for most lenders tends to cost or lose them upwards of $7,000 to $8,000 for everything that's hooked to a tow truck and towed off. So if they can help prevent, 3 or 4 or 5% of their outflow of volume by curing that loan earlier, or if they're able to get it earlier, then yeah, the interest hasn't added up as high, the penalties and fees may not be as high, and the redemption process may be at a point that the loan isn't charged off yet, so they're not asking for a full balance payoff or nothing else. So the only way to get the car is you pay us in full balance, or we're taking it to auction and selling it. So it's really important, in my opinion, to pay attention to the timing factor associated with collections and recovery, because if you can recover that car earlier, then it's gonna mean a lower fee for the customer to get back in the car. But if the customer can't afford to get back in the car, then it's also going to mean a lower deficiency balance that you're going to have to carry forward and try to collect on later on down the road, which obviously brings your overall organizational costs down slightly due to just the timing factor.
Excellent, excellent. That's Jeremiah Wheeler, the Vice President of Financial Services at DRN, and Jeremiah and the rest of the team can be reached via their website, drndata.com. More information about their products and services are certainly available there, and their team is available to answer the questions you might have about how this location data can help mitigate risk at your operation, whether you're just strictly a finance company or a dealership who is originating paper as well. So again, that's drndata.com. And so to wrap it up today, Jeremiah, if you could perhaps maybe just kind of close again with the kind of the bullet points of the enterprise model and the recovery model that DRN offers, and as well as any other points of how finance companies and dealerships can improve and mitigate risk here now in the second quarter and beyond for the rest of the year.
Well, I'd say, first of all, we're more than happy to speak with anyone offline about any other questions or concerns or anything that you have. Happy to talk through with you some of the strategies that we've seen work in other lenders, as well as, we have a list of references with lenders that have agreed to be references with us because they are seeing great results. That would be more than happy to talk with you about what they're doing, how they're doing it, what they're seeing, the returns, and we're happy to walk through those necessary steps to help you price out the right model that will work for your organization, to be sure that we can work together to continue the partnership and provide you with better returns and mitigate more losses and risk for you, as well as obviously the big thing I think for most lenders out there, you need to be able to identify that risk before you can really do anything on it. So it's really more about the monitoring aspects and the scoring aspects that we've seen more and more lenders starting to adopt. And I think that's the next wave of the lending future, so to speak, and the collections future, is helping bring in more and more data sets, not just where data, but bringing in all different types of data sets. And a lot of them that we see are not self-reported by the customer themselves. So happy to walk through that with you and go all the way through the process.
Very good, very good. Again, our special guest today has been Jeremiah Wheeler, the VP of Financial Services at DRN. Excellent job as always, Jeremiah. Thank you so much for the information and recommendations today.
Absolutely. Thanks everyone for joining. I appreciate your time. I know everyone's busy, and we really appreciate your time and look forward to working with all of you.
And again, on behalf of Subprime Auto Finance News and Cherokee Media Group, I'm Nick Zulovich. Thank you so much for joining us.